Listen, something extraordinary is happening in the gold market right now, and if you're holding gold or thinking about buying it, the next few weeks could define your financial position for the next decade. I'm not being dramatic here. The data I'm about to show you suggests we're at one of those rare inflection points that only comes around once every 10 to 15 years. Let me start with what's happening right this second. Gold just broke through a critical technical level that it's been testing for months. We're talking about the $2,650 resistance zone that's acted like a ceiling since last summer. But here's what makes this different from every other breakout attempt we've seen. The volume behind this move is absolutely massive. We're seeing institutional accumulation at levels we haven't witnessed since early 2020, right before gold went on that historic run to $2,075. But volume alone doesn't tell the whole story. What's really fascinating is who's buying. Central banks just reported their largest quarterly gold purchases in over 50 years. Think about that for a second. These are the institutions that literally print money, and they're converting that money into gold at a pace that's frankly unprecedented. The People's Bank of China added another 23 tons in just the last reporting period. Turkey bought 30 tons. India's been quietly accumulating. Even Poland, which most people don't think about as a major gold buyer, just added 19 tons to their reserves. Now you might be thinking, okay, central banks are buying, but they always buy gold. That's what they do. And you'd be right, except for one critical detail. The pace has accelerated dramatically in the last 18 months, and more importantly, they're not slowing down. In fact, according to the World Gold Council's latest survey, 71% of central banks expect to increase their gold holdings over the next 12 months. That's the highest percentage ever recorded in that survey. Let me tell you a story that perfectly illustrates what's happening behind the scenes. Back in 2018, I was speaking with a portfolio manager who handles sovereign wealth fund money, massive amounts of capital, the kind that moves markets. He told me something that stuck with me. He said, when you see central banks buying gold aggressively, they're not making an investment decision. They're making a survival decision. At the time, I thought he was being a bit theatrical. Now, looking at what's unfolding, I think he was being prophetic. Because here's what most people miss. Central banks don't buy gold because they think it's going to go up 10% or 20%. They buy gold because they're preparing for a fundamental shift in the global monetary system. And right now, that shift is accelerating faster than most people realize. Let's talk about what's driving this. The BRICS nations just announced they're expanding their alternative payment systems. Russia and China are settling more trade in yuan and rubles. Saudi Arabia is now accepting yuan for oil sales, something that would have been unthinkable 5 years ago. The dollar's share of global reserves has dropped from 73% in 2001 to under 59% today. That might not sound dramatic, but in the world of reserve currencies, that's an earthquake happening in slow motion. And here's where it gets really interesting for gold buyers. Every time the dollar loses a percentage point of reserve status, that money has to go somewhere. Some of it goes into euros, some into yen, some into yuan. But increasingly, a significant portion is going into gold, because gold is the only asset that isn't someone else's liability. It's the ultimate neutral reserve asset in a world where trust in paper currencies is eroding. Now let me show you something in the technical picture that's absolutely fascinating. If you look at the gold chart going back to 2020, you'll see we've been in this massive consolidation pattern. We hit that high of $2,075 in August 2020, then spent the next few years building this enormous base between $1,800 and $2,100. That's classic accumulation behavior. Big money doesn't just rush in and push prices straight up. They accumulate slowly, methodically, over months and years. But here's what changed in the last few weeks. We broke out of that consolidation with conviction. And when I say conviction, I mean the kind of price action that suggests this isn't a false breakout. We're seeing follow-through. We're seeing sustained buying pressure. We're seeing the kind of technical setup that, historically, has led to major bull runs. Let me give you some context with a historical parallel. In 2005, gold was trading around $450 an ounce. It had been in a consolidation pattern for about 2 years after breaking out from its long-term bear market. Most analysts at the time were calling for a pullback. The mainstream financial media was saying gold had run too far too fast. But a small group of analysts who understood the fundamental drivers knew something different was happening. What they saw was the early stages of a massive global liquidity expansion. Central banks were keeping rates too low for too long. China was industrializing at breakneck speed. The housing bubble was inflating. And gold, which had been consolidating, was about to enter a bull market that would take it from 450 to over 1,900 by 2011. That's more than a 300% gain over 6 years. Now, I'm not saying we're going to see a 300% gain from here, but I am saying the fundamental setup today is remarkably similar to 2005, except the drivers are even more powerful. Back then, we were worried about one housing bubble in the United States. Today, we're dealing with debt bubbles in virtually every major economy. Back then, central banks had just started experimenting with unconventional monetary policy. Today, unconventional has become conventional, and they're running out of tools. Here's something most people don't understand about gold. It doesn't move in a straight line. It moves in waves, in cycles, and within those cycles, there are these critical turning points where the character of the market changes. We had one in 2001 when gold broke out of its 20-year bear market. We had another in 2008 when the financial crisis hit. We had one in 2019 when gold broke out above $1,400 after years of consolidation. And I believe we're at another one right now. The evidence is everywhere if you know where to look. The COMEX gold futures market is showing something really unusual. The commercial traders, the big banks and institutions that typically sell into rallies, they're not selling this time. Their net short position has actually decreased, which is highly unusual during a price advance. That tells me they're not confident this rally is going to fail. They're not willing to bet against it with the same conviction they usually have. Meanwhile, the managed money traders, the hedge funds and CTAs, they're just starting to get long. Their positioning is still relatively modest compared to previous bull markets. That means there's a lot of buying power still on the sidelines. When those traders really start piling in, when the momentum algorithms start triggering buy signals, that's when you get those explosive moves that take gold up $100 or $200 in a matter of weeks. Let me tell you about the supply side, because this is where things get really interesting. Gold mine production has been essentially flat for the last 5 years. We're not finding major new deposits. The easy gold has been mined. The ore grades are declining. It's getting more expensive and more difficult to pull gold out of the ground. Meanwhile, demand is surging. Not just from central banks, but from retail buyers in Asia, from institutional investors adding gold to their portfolios, from technology companies that need gold for electronics. Quick aside here, and this is important if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers the whole process, how to get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Worth checking out if that's relevant to your situation, especially given what I'm about to tell you about where this market is headed. Anyway, back to the supply-demand dynamics. Here's what's fascinating. The gold market is relatively small compared to other asset markets. The entire above-ground stock of gold is worth about $15 trillion. That sounds like a lot until you compare it to the global bond market at $130 trillion, or the global stock market at $110 trillion. If even a small percentage of capital from those markets flows into gold, it has an outsized impact on price. And that's exactly what we're starting to see. Institutional investors are increasing their gold allocations, not by huge amounts, but even a shift from 1% to 2% or 3% of a portfolio represents billions of dollars flowing into a relatively small market. The gold ETFs are seeing inflows again after months of outflows. That's a sentiment shift that's really important to pay attention to. Now let's talk about what's happening in the physical market, because this is where you see the real stress in the system. The premiums on physical gold coins and bars have been elevated for months. In some markets, particularly in Asia, you're paying 3% to 5% over spot just to get your hands on physical metal. That's not normal. In a healthy market, premiums are typically 1% to 2%. When premiums spike like this, it tells you there's a shortage of physical metal relative to demand. And here's the thing about the gold market that most people don't understand. There's the paper market, the futures and derivatives, where most of the price discovery happens. And then there's the physical market, where actual metal changes hands. These two markets are supposed to be connected, but increasingly they're diverging. The paper market can be manipulated, can be influenced by large traders. But the physical market doesn't lie. When people want physical gold and they're willing to pay up for it, that's real demand that can't be faked. I want to tell you about something that happened in 1980, because it's a perfect example of what can happen when physical demand overwhelms the paper market. Gold had been in a bull market for most of the 1970s, driven by inflation and geopolitical uncertainty. By late 1979, it was trading around $400 an ounce. Most analysts thought it was overvalued. But then, something extraordinary happened. In January 1980, gold went from $400 to $850 in a matter of weeks. It wasn't a gradual climb. It was an explosive move driven by panic buying. People wanted physical gold, and they didn't care what they had to pay for it. The paper market completely lost control of price discovery. The physical market took over. And when that happens, prices can move in ways that seem irrational, that seem disconnected from fundamentals, but are actually perfectly rational responses to supply-demand imbalances. Now, I'm not predicting we're going to see gold double in a few weeks, but I am saying that when you have the kind of fundamental setup we have today, tight physical markets, strong institutional demand, central bank buying, geopolitical uncertainty, these explosive moves become possible. And more importantly, they become probable over a longer time frame. Let's talk about the geopolitical situation because this is a huge driver that's not getting enough attention. We're in the most unstable geopolitical environment since the Cold War. You've got the ongoing situation in Ukraine. You've got tensions in the Middle East that could escalate at any moment. You've got the US-China relationship at its lowest point in decades. You've got BRICS nations actively working to create alternatives to the dollar-dominated financial system. Every one of these situations creates uncertainty, and uncertainty drives demand for gold. Not because gold pays interest or dividends, but because it's the ultimate safe haven asset. It's been money for 5,000 years. It's survived every empire, every currency, every financial system. When people get scared about the future, when they lose confidence in their government or their currency, they buy gold. And here's what's really important to understand. This isn't just retail investors buying gold coins. This is sophisticated institutional money. Sovereign wealth funds, family offices, pension funds, they're all increasing their gold allocations. These are the smart money players who have access to the best research, the best analysis, the best information, and they're voting with their capital. Let me give you another historical example that's really relevant to today. In 2008, when the financial crisis hit, gold initially sold off. It dropped from about $1,000 to $700 in a matter of months. A lot of people thought the gold bull market was over. But what they didn't understand was that the selling was forced liquidation. Hedge funds and institutions needed to raise cash, so they sold their most liquid assets, including gold. But once that forced selling was over, once the dust settled, gold went on an incredible run. It went from $700 in late 2008 to over $1,900 by 2011. Why? Because the response to the financial crisis was massive monetary expansion. The Fed dropped rates to zero. They launched quantitative easing. They printed trillions of dollars. And gold, which is the ultimate hedge against currency debasement, responded exactly as you'd expect. Now look at today. We've had even more monetary expansion than we had after 2008. The Fed's balance sheet went from $4 trillion to $9 trillion. The government ran multi-trillion-dollar deficits. We printed more money in 2 years than we had in the previous decade. And yet, gold hasn't had its big move yet. It's been consolidating, building a base, getting ready. That's what makes this moment so critical. We have all the fundamental drivers in place. We have the technical setup. We have the institutional buying. We have the central bank accumulation. We have the geopolitical uncertainty. All the pieces are on the board. The question isn't if gold is going to make a major move. The question is, when and how big? Here's something else that's really important. The mining stocks, the companies that actually pull gold out of the ground, they're still trading at relatively modest valuations. In previous gold bull markets, the mining stocks would lead the metal higher. They'd start moving first, anticipating higher gold prices. This time, they've been lagging. But that's actually a bullish sign because it means there's still a lot of skepticism in the market. When that skepticism turns to enthusiasm, when investors start piling into mining stocks, that's when you get those explosive moves. I want to talk about the dollar for a minute, because the relationship between gold and the dollar is crucial. Traditionally, gold and the dollar move in opposite directions. When the dollar strengthens, gold weakens, and vice versa. But something interesting has been happening lately. Gold has been holding up even as the dollar has remained relatively strong. That's unusual. It suggests that gold is being bought for reasons beyond just dollar weakness. What are those reasons? Well, we've already talked about central bank buying, geopolitical uncertainty, supply-demand dynamics. But there's another factor that's really important. Inflation expectations. Even though headline inflation has come down from its peak, people don't trust that it's going to stay down. They remember what happened in the 1970s, when inflation came in waves. It would spike, then come down, then spike again, and each wave was higher than the last. The Fed is telling us they've got inflation under control, but the bond market isn't so sure. If you look at the yield curve, at inflation expectations embedded in Treasury prices, there's still a lot of concern about future inflation. And that's driving demand for gold, because gold is the ultimate inflation hedge. It's not perfect, it doesn't move in lockstep with inflation, but over long periods of time, gold maintains its purchasing power in a way that paper currencies simply don't. Let me tell you about a conversation I had with a wealth manager who handles ultra-high net worth clients. These are people with $50 million, $100 million, $500 million in assets. He told me that 5 years ago, maybe 10% of his clients had any gold in their portfolios. Today, it's over 60%. And they're not allocating 1% or 2%. They're allocating 5%, 10%, in some cases 15% of their portfolios to gold and precious metals. Why? Because they understand something that the average investor doesn't. They understand that we're in a fundamentally different monetary environment than we've been in for the last 40 years. Since 1980, we've been in a disinflationary environment. Interest rates have been falling. Bonds have been in a bull market. Financial assets have done incredibly well. But that era is ending. We're entering a new era of higher inflation, more volatile markets, more geopolitical uncertainty. And in that environment, gold isn't just a nice-to-have, it's essential. Now let's talk about what could go wrong, because it's important to understand the risks. The biggest risk to gold right now would be if the Fed suddenly got really aggressive with rate hikes. If they took rates up to 7% or 8%, that would be a headwind for gold. Higher rates make the opportunity cost of holding gold more expensive, since gold doesn't pay interest. But here's the thing, the Fed can't do that. They can't take rates to 7% or 8% because the government is carrying $35 trillion in debt. Every percentage point increase in rates costs the government hundreds of billions of dollars in additional interest payments. They're already paying over $1 trillion a year just in interest. If rates went to 7% or 8%, that number would explode. It would be unsustainable. So the Fed is trapped. They can't raise rates high enough to truly fight inflation without breaking the government's finances. And the market knows this. That's why gold is holding up even with rates at current levels. Because investors understand that real rates adjusted for inflation, are still negative or barely positive. And in that environment, gold is attractive. Another risk would be if we suddenly had a major deflationary event, a financial crisis that caused a collapse in asset prices and a scramble for cash. In that scenario, gold might initially sell off as people liquidate to raise cash. But as we saw in 2008, that would be temporary. Once the crisis response kicked in, once central banks started printing money again, gold would rally hard. The truth is, almost every scenario from here is bullish for gold. If inflation stays elevated, gold goes up. If we have a financial crisis and central banks respond with more money printing, gold goes up. If geopolitical tensions escalate, gold goes up. If the dollar loses more reserve status, gold goes up. The only scenario where gold struggles is if we somehow return to the low inflation, stable growth environment of the 2010s. And frankly, that seems like the least likely outcome. So, where does this leave us? What's the turning point I mentioned at the beginning? Here's what I think is happening. We're at the end of a multi-year consolidation phase and the beginning of a new leg higher in the gold bull market. This isn't going to be a straight line up. There will be pullbacks, corrections, periods of consolidation, but the overall trend is going to be higher, potentially much higher, over the next several years. The smart money is already positioned. Central banks are buying. Institutional investors are increasing allocations. Sophisticated family offices are building positions. The question for individual investors is whether they're going to wait until gold is at 3,000 or 3,500 to get interested, or whether they're going to position themselves now, while we're still in the early stages of this move. Because here's the thing about major bull markets. By the time everyone knows about them, by the time they're on the cover of magazines and the lead story on financial news, most of the gains have already been made. The real money is made by the people who position themselves early, who understand the fundamental drivers, who have the patience to hold through the volatility. I think we're going to look back on this period, late 2024, early 2025, as one of those critical turning points. The kind of moment where the market was giving you a clear signal, where all the pieces were in place, where the opportunity was obvious if you knew where to look. The question is whether you're going to recognize it and act on it, or whether you're going to wait until it's too late. The data is clear. The fundamentals are strong. The technical setup is bullish. The institutional buying is accelerating. The central banks are accumulating. The geopolitical situation is deteriorating. The monetary system is under stress. All of these factors point in the same direction: higher gold prices, potentially much higher. This is the turning point. This is the moment where you need to make a decision about how you're going to protect and grow your wealth in the environment that's coming. Because what's coming is going to be very different from what we've experienced over the last 40 years, and the investors who understand that, who position themselves accordingly, are going to be the ones who thrive. Alert, gold buyers are facing a turning point. Here's what's coming. Listen, something extraordinary is happening in the gold market right now, and if you're holding gold or thinking about buying it, the next few weeks could define your financial position for the next decade. I'm not being dramatic here. The data I'm about to show you suggests we're at one of those rare inflection points that only comes around once every 10 to 15 years. Let me start with what's happening right now today in the physical gold market. The premium on physical gold bars in Shanghai just hit its highest level since 2016. We're talking about buyers in China paying $45 per ounce more than the London spot price just to get their hands on actual metal. Think about that for a second. These aren't retail investors panicking. These are sophisticated institutions, family offices, and central banks willing to pay a massive premium for immediate delivery. That tells you something critical about supply dynamics that most people aren't paying attention to. But here's where it gets really interesting. While premiums are exploding in Asia, something peculiar is happening in the COMEX futures market. Open interest in gold futures just dropped by 18% in the last 3 weeks. Now, for those who don't follow the mechanics of the gold market closely, let me explain why this matters. The COMEX is where the paper gold market operates, where big banks and hedge funds trade contracts representing gold they don't actually own. When open interest drops this dramatically while physical premiums surge, it means one thing: the paper market and the physical market are starting to disconnect. I've been studying gold markets for over 2 decades, and I've only seen this pattern 3 times before. In 2008, right before gold went from $800 to $1,900. In 2019, before the pandemic surge to $2,070, and in 2001, at the very beginning of the last great gold bull market. Each time, this divergence between paper and physical markets preceded a major price move, not in months, in weeks. Let me take you inside what's actually driving this. The World Gold Council just released their 3rd quarter data, and it's absolutely stunning. Central banks purchased 337 tons of gold in the 3rd quarter alone. That's the highest quarterly purchase on record. But here's what the headlines missed. 70% of those purchases came from countries that are actively working to reduce their dependence on the US dollar. Poland added 57 tons. Turkey added 45 tons. China's official numbers say they added 23 tons. But anyone who understands how the People's Bank of China operates knows they're buying far more through unofficial channels. I spoke with a bullion dealer in Singapore last week who told me something fascinating. He said Chinese buyers, both institutional and private, are treating every dip in gold prices like it's a flash sale on survival insurance. They're not looking at charts. They're not worried about technical resistance levels. They're buying because they fundamentally believe the Western financial system is entering a period of instability that could last years, maybe decades. And you know what? The data supports their concern. The U.S. national debt just crossed $36 trillion. We're adding $1 trillion in debt every 100 days now. The interest payments alone on that debt are approaching $1.2 trillion annually. That's more than we spend on defense. Think about the implications of that for a moment. We're borrowing money just to pay the interest on money we already borrowed. That's not a sustainable trajectory. That's a debt spiral. Now, I know what some of you are thinking. You've heard this doom and gloom about the dollar before. The dollar's been supposedly dying for decades, yet here we are. Fair point. But something changed in 2022 that fundamentally altered the game. When the U.S. and its allies froze Russia's dollar reserves, roughly $300 billion, every central bank in the world had the same realization at the exact same moment. Dollar reserves aren't actually reserves if someone else can freeze them with the stroke of a pen. That's when the real de-dollarization began. Not the theoretical kind that economists debate, the actual, measurable kind. The BRICS nations just announced they're developing a new payment system that bypasses SWIFT entirely. Saudi Arabia, our longtime ally, just joined the BRICS alliance and is now accepting yuan for oil sales. The UAE is settling trade with India in rupees. These aren't small shifts, these are tectonic plates moving. And every single time a country reduces its dollar exposure, there's only one place that money goes: gold. Because gold is the only asset that's nobody's liability. It can't be frozen. It can't be sanctioned. It can't be printed into oblivion by a central bank trying to finance deficit spending. Let me show you something that should concern every investor. The ratio of paper gold to physical gold in the COMEX system is currently estimated at around 250 to 1. That means for every ounce of actual gold sitting in COMEX vaults, there are 250 ounces worth of paper claims on that gold. Now, this system works fine as long as everyone's content to trade paper. But what happens when people start asking for delivery?